Okay, good afternoon, everybody. Today is May 27th. This is your weekly take on the market. I will be your host. No surprise. My name is Scott St. Clair. I'm the manager of the premium product group here at Investors Business Daily. Take a moment to read the disclaimer. We're not licensed at IBD. We don't provide buy, sell, hold recommendations. All right, so you guys know the drill. We'll talk about the markets. We'll talk about the industry groups, see if there's anything changing there, some stocks that are of interest, and then the quote of the week. All right, so let's jump right into it. So here is a chart of the S&P 500. Yesterday was a follow-through day. IBD went to confirmed uptrend. And, the volume was very light yesterday, but it was bigger than the day before. Now, in MarketSmith, we use a different volume feed than IBD. So their volume was different and was above the threshold to qualify for a fall through day. That's why it looks a little differently here. We hope to sync the two eventually, but it goes back to the days when we were separate companies. Anyways, that's the short, quick answer for that. But today you had a really powerful follow through of the follow through day, which is nice. It's unusual. You actually have your first higher high that you haven't had in a while. This higher high failed pretty quickly early in the downtrend, but then you just haven't had too many higher highs along the way, or so let's see if this can hold. Let's go to the NASDAQ. So yesterday was a follow through day, and today a little bit, more added on. Now, the follow through day is a bit misunderstood. It doesn't work every time. So you have to understand that there is no perfect system in the stock market. The last perfect system that I'm aware of was Bernie Madoff's. And we all know how that ended, right? He never got it wrong until he got it completely wrong. And Long-Term Capital, who never got it wrong hardly ever until they got it completely wrong. So there are going to be hiccups and false starts and false positives and all that stuff. It's a risk reward setup. If you're risking $1 to make $3 or $4 or $5, you don't have to be right that often. Right. And that's what the market provides if you allow it to, right? If you allow it to stretch your gains and minimize your losses. So the main thing though is, and I'm the first to say I've kind of ignored the market, the indexes for gosh, maybe the last 5 or 6 years. It's just played lesser of a role in my decision making because the indexes are very hard. They're so closely observed, right? So there's a lot of eyeballs on the indexes. So there's going to be some false starts, some hiccups along the way. So if keep it, however you want to do it. But the thing about a follow through day is it's going to signal, and we'll know after, the start of a new bull market. I don't know if this is the start of a new bull market. I don't believe anybody knows. I don't know if it's a tradable rally. I don't know what a tradable rally is, to be honest with you, but I don't know anybody that knows that. And I don't know if it's a bear market rally. I don't know anybody knows that. So just play it day by day, moment by moment, manage your risk, the stocks you're in, what kind of feedback are you getting? If you're in ARK and Tesla and Apple, you've probably had a really lousy year. If you've been in Devon Energy and Halliburton and Chevron and Exxon, you'd be like, what bear market? So there's more to it than meets the eye with just the indexes. So, but IBD, last Friday I talked about the divergence, which turned out to be a good omen. Like, it bothered me. I got off the short side except for one small short because of the divergence. Right? You had a new low in the NASDAQ. You had a new low in the S&P here on this day, and you did not have a new low in the Russell and on even, kind of going on the spectrum on ARK. And ARK led the market down. ARK topped months before the overall market. ARK topped in February. So did some really big funds. The market topped in November of last year. Right there. So let's go back to the divergence. NASDAQ makes a new high. S&P makes a new high right there. Bear with me here. Almost messed that up. So November of last year, right? NASDAQ does not make a new high in December, does not make a new high. The S&P does right there. There's your divergence. Alarm bells going off for me. Stocks are starting to roll over, right? A lot of stocks had already topped in February, March, April, May. They're going lower. They're going lower. And you finally have your divergence to the upside. Fast forward to now, you have, and I wish it was S&P and NASDAQ because they're bigger markets. That's a better divergence indicator. But, you know, it is what it is. S&P made a new low. NASDAQ made a new low. Russell did not. So you have a positive divergence there. And, you know, therefore you've got a rally. And maybe this one's real. Who knows? The VIX is not that elevated. And I noticed somebody, let's go to weekly chart. Somebody posted, I hope I get this right, that no bear market has ever bottomed with the VIX having never printed above 40. In other words, every bear market, let's go to monthly. So here's the COVID 85. Here's the great financial crisis 89. Here's the tech bubble, you know, a couple of times, 43, 45. Here's long-term capital in the Asian financial crisis, 45. Here's the Christmas Day massacre, the Powell pivot, right? He's trying to raise rates. Markets just throw up on themselves, and he pulls back and says, whoa, I don't think I can raise rates here at 50. So this is this one, and, you know, I didn't look back, but these are just, you know, the most recent ones, you know, 20 years. And he's the guy who tweeted that, said it's never happened. I don't know how long the VIX has been around, 35 years, something like that. So the sample size ain't great, but, you know, and there was always exceptions to every rule, but, you know, maybe this time is different. This has been, let's go back to the indexes. And I know the NASDAQ is, you know, from high to low, I think that was what, 30-some%. But for most stocks, the average stock, the growth stocks, 30% has been the bare minimum. There are so many that are down 30, 50, 70%, you know, from high to low. So it's been a really, really bad bear market. If this is the low, there's been enough damage as far as price action, I think. The S&P, you know, stopped at, you know, if you're going to include intraday, I think intraday was 20%, but end of day, probably 19 and change. Same thing, you know, not as much damage in the S&P because the S&P has some energy and some industrials and some companies that make stuff. If you make stuff this year, coal, energy, oil, you've probably had a pretty good year as a company. And if you have a lot of intangibles on the book, as far as your company value, then you've probably had a lousy year as a general rule. So that's it. That's it for the indexes. We'll see how this plays out. I'm optimistic. Hopefully, you know, there's been enough damage. I think it's going to take time for stocks to build bases, but they build bases pretty quickly, as you'll see when we go through them. Was there anything else I wanted to say about the indexes as a general rule? All right, so let's go to the industry groups. Energy coal is 1, oil and gas drilling is 2. We know the drill. What I'll do this weekend is I'll scan my eye here for big numbers and look for changes like, wow, metal production distributors 147, 30, 23. The other thing I look for is this number of stocks. It's 3. Well, I could look at that pretty easy, but that's going to skew the rankings a little bit, both good and bad. So I think there's another one up here. Is it media periodicals? Yeah, 3. You must have one stock doing really well. So let's go. I think one that stood out to me was chemicals specialty. So 66, 56, 47. I like to find, once chemical specialty, if it becomes the first group, it's going to be too late. The stocks are not going to be viable. So you got to find them as they're moving up the food chain. So next week, this might be 30, and the following week, it might be 18, and so on and so forth. I don't know if it's going all the way, but how do they get to the number one group? They start somewhere here and work their way up. They don't have to start way down the food chain, but start somewhere and work their way up. So I double click chemical specialty. You can see this is a chart of the group as a whole. I'm going to open up this related information panel. And I'm going to choose stocks and group. These are the stocks in the group by market cap. Not as important to me as quality. So I'm going to click on this button, show all component data, and MarketSmith will sort this list for you based on the EPS and RS rating. So it'll combine those two ratings, the largest number on top. So Ashland is the highest, Univar. What made me think of this was somehow I came up across VHI, and this was a stock that I was in. I can't even remember when I was in it. I think it might have been over there, but it was just too thin for me. And I moved on and kind of took it off the screen. You can see it trades 36,000 shares, even though the volume is really starting. And these are big volume bars. It's less than 100,000 each day. So it was pretty thin, but I saw that as quite a move. I was like, oh, but there are other stocks in the group. CC just broke out. This is bigger, something like that. LTHM, maybe the reason I came across this group was because of lithium. Mentioned on IBD Live this morning, breaking out of a base. I think the pivot was 29.58 above that. Marcus sees this kind of larger cup, but you can see this is a big earnings and sales last few quarters, relative strength line new high, coming out of a base, market's finally getting better. This is what you want to see. Let's go ahead and just jump right into stocks. The other one that kind of jumped out at me was P-Lab. And interesting, it goes from the 10 or the 40-week line, I should say, to brand new highs in 1 week. And immediately I thought of Netflix when that did that. This week, it was January 29 of 2010. So Netflix, and let's put the index across the top so you can kind of get an idea. So we're in a bear market like this. Excuse me, sorry about that. And Netflix is kind of making a series of higher highs. The relative strength is really good. And then it's correcting. And then I'm sure it was earnings related, if I recall. Boom, straight to new highs. Gaps up, I think 20%. And 23% that day. So, that's pretty good power. It's amazing power. What did it do the following week? Went sideways for a tiny bit. What did it do the following week? Went sideways for a tiny bit. And then it started to trend. So when I look at P-Lab, I almost bought P-Lab, but I thought, well, if my precedent for Netflix is the same, maybe a small little short stroke for a week or two, if we can hold these gains, and then I can consider it. There are a couple of other stocks in the area that are, GFS is starting to hold up a little bit better. It's not ready, but it's starting to round out. I liked AOSL coming out of this space, big earnings and sales. It's got all the trappings. The group is really poor, but it's just not ready technically. But I was tempted, this is why a lot of people like to buy on the way down, because if you catch it, let's say I just bought AOSL at 33 just because I thought it was cheap. It's 46 now. It's very tempting. You've seen that in a lot of stocks like C Limited. This doesn't look like anything on the chart, but that's over 50% off the low. I think coin has almost doubled off the low and you can barely see it. But if you thought here, and then it doubles, you're still underwater 50%. So that's why that's not really our strategy, or definitely isn't our strategy. Plus, look at the fundamentals. They're deteriorating rapidly versus previous. So I'm always looking for, ideally I want the fundamentals to be there. Look at these quarterly earnings and sales. So it's been a bull market in energy. Is it going to continue? I don't know, but there's been a lot of really good energy stocks. EQT. This was in hindsight, it was just like a slam dunk. Bill O'Neill would always say the first pullback to the 10-week line after a big move is a layup. It's a must own. So I mean, it has to work. No, but you should put those on because the probabilities are high. And if you get it right. So I didn't own EQT coming out of that base, but all I could think about on that pullback was Bill talking about, must own on the pullback to the 50-day. CNQ, undercut. So that one didn't quite work, but building a base. Halliburton, undercut, building a base. So there's a lot of good stocks in this area. Zim, another stock that's holding up really well. And the main thing you'll find with the stocks that I choose, almost always, they have big earnings and sales. You're just going to improve your Zim, your selection so much better when you fish in this stream of big earnings and sales. Halliburton, this is a big company, the leader in oil and gas field services. And so 84% and 24%, those are really good numbers for a company like that. So ideally, I would say if I own 10 stocks, 8 of them would have this. I will own some quote unquote special situations. Valaris, I really like the offshore oil and gas drilling. I feel like they could really gush profits if oil stayed up here. Because this seems like a long-term cycle of, you put an oil rig off the coast, that's not something that's easily moved, and it's setting up really nice, but last quarter still losses. So this is kind of a special situation coming out of an ascending base. And I think there's a couple of other shipper. GLNG it's holding up okay, had a nice shakeout on the earnings, up 999%. They made $5 that quarter, $5 and change. I mean, they've never made $5. Doesn't look like they ever make money. I don't know. I'd probably have to dig into what is exactly going on here. Are they rolling all that money back into more vessels, or so to speak? But that seems like a pretty good quarter. And so there's potential base there. And there's a few in this group. There's a new one. How did this one do? Accelerate. And then FLNG, which I've owned for a while, which pays a good dividend, is hanging around the 10-week. So there's been stuff to own. And so if you've been in the right areas, if you're looking for tech stocks, then it's going to take some time. High growth stocks, if this is real, you probably need at least a couple more weeks to get that going. All right, so markets, industry groups, stocks to watch, the quote of the week. So let me set the quote up. I don't know if you've seen the study by Henrik Bessembeiner. He's I don't know if he still is, a professor at Arizona State University. And I feel like I've talked about this either on webinars or on this before. But basically 90% of the stocks, let's just say, whatever the number is, the vast majority of stocks underperform the markets and or cash. There really are only just a handful of stocks that account for all the index gains, the Amazons, the Apples of the world. It's funny, the S&P is diversified, but it also lets its winners run, and they cut their losers as well. They might cut them, way down after they've really cratered, but they do cut losers. They do remove stocks if something's totally wrong with it. And as Apple goes up, it becomes a greater percentage of the index. So it provides, more gains. And so it's really, they're compounding their winners, which is the right strategy. So most stocks are not going to perform. And so I was listening to Bill Miller, He is the founder of Miller Value Partners. He's famous for having beaten the S&P in a mutual fund. I think it was Legg Mason Value, 15 years in a row. I can't remember the time period, somewhere late 90s, early aughts, somewhere in that range. And he was, I don't know if he was quoting this study or not. He didn't say, but he says all the returns of the S&P 500 come down to about 4% in the companies that are publicly traded. Therefore, 96% of the companies you don't want to own. They're not going to outperform the index, and probably most of them will underperform cash. In other words, they're losers. So if you're trying to build a diversified portfolio with a lot of stocks in it, you are almost guaranteed to underperform. This is what really stuck out to me, is this. If you own too many stocks, you're almost guaranteeing underperformance. Now, if the S&P goes up 25%, you might go up 20. It doesn't mean you're going to lose, but you're probably going to lag the indexes if you have too many stocks. So you want to really concentrate, and what that number is, you've got to decide for yourself. I think it's very personal. I just use 10. It's a simple number, and I think having 10 or less. I very rarely own 10. Most of the time I own less, but I like to cap it at 10. And that might mean I own 6, and I have, but I'm 60% invested. So I don't have to be 100% all invested all the time. I want to use the right sizing that I can handle the volatility of the stocks. But I can't remember the last time, if ever, I've owned more than 20 stocks. I just don't do that. I think if you want to research that, you'll find that after about 22 or 24 stocks, there's very little diversification. If I own 22 stocks and you own 222, the standard deviation of our portfolios is very, very similar. I'm only taking a tiny bit more risk than you. Whereas if things go bad, it's going to take you forever to get out, to reduce. And I could sell 10 stocks and reduce my exposure in half. You would need to sell 100 to do that. You see where the problem comes in. So you're better off owning a few. And if 10 is too little for you, I would say do the research, do the academic, or read the papers. I think it'll help you to understand the value of being more concentrated than most people feel comfortable with. But you have to feel comfortable with it. You don't panic at the wrong times. And I would say if you choose 20 and you don't feel like the market's great and you're at 20, maybe you have half your money in 20 stocks, but then stop right there and wait and see if you get a cushion. See if you start getting some movement. You can add to those 20 and gradually go from 50 to 60, or maybe you can push out some that aren't working and add to the others. But if Mark Minervini famously says, if you can't make money 50% invested, what makes you think you're going to make it 100% invested? And it's so true, right? If you're not doing well with what you have, why do you need to go out further to try to do well? You're probably just going to make it worse and things aren't going well. So he was talking about Bailey Gifford, the manager of Bailey Gifford. I believe he's retired now, but Bailey Gifford's a really good fund company. They had a massive position in Tesla before the big move. I feel like they've trimmed a bunch of it now, but and they concentrate by mutual fund standards. And so their track record is really good, although the concentration does hurt them. I think the high to low, some of their funds are off 50% in this meltdown, which just come full circle back to the fact that this was a nasty bear market if it's over. If a really good mutual fund with quality research and really good track record goes down 50%, it gives you a good idea about the market. So he says, this gentleman, this fund manager says, I ask myself and my team, is this particular company likely to be one of the 4%? Right? If this is going to be one of the 4% of the S&P 500 that outperforms. Now, their universe, because of liquidity, they're managing billions. I was thinking of putting some money in the fund, and the minimum was just outrageous. I was like, nah, I don't think I want to do that. I don't want to be tied in with that type of minimum. But and maybe it's institutional minimum. They might not even be willing to take my money. I didn't even get that far when so, but you know what, their universe is big and liquid. Our universe is, we don't need to, like VHI, that one, that might be a little small, but we have a lot more potential merchandise. So let's say that of the 5,000 potential stocks we can buy, let's say 10% of them are going to outperform. So ask yourself, what is this likely to be? One of the 10%? What are the characteristics of those? Is this one of them? Earnings, sales, products, services, group strength. Does the group have a tailwind? And you look at these charts like FANG and Devon Energy. FANG broke out, which is why it reminded me of that. So this is when oil is on its way to negative. Right? That's a massive, massive headwind. The greatest companies can't survive that. Right? And now oil is coming back. It's above $100. Now they've got a massive tailwind. Look how well that stock has performed. So you have to think about those things when you're considering stocks. I know it's hard. You have to make a forecast of what oil is doing. But if oil is 50, 49, 48, 47, 46, 45, it's in a downtrend. It's pretty simple. And on the way back up, it's 30, it's 40, it's 50, it's 60, it's 70, it's 113 now. It's in an uptrend. When is it going to stop? I don't know. 200? I don't know. I don't know. I imagine it could go anywhere. And eventually it will stop and your rules will get you out. But that is pretty much the simplest thing, is think about, does this company have a headwind or a tailwind? And sometimes it's commodity related, and sometimes it's group related, or market related, like, Snowflake had a tailwind. It had a tailwind. The market didn't care the fact that they weren't making earnings, didn't care that it was trading at 20 times sales or whatever the number was, didn't care. And I did really well in Snowflake in this move, really well. Like it was one of my biggest winners that year. I didn't trade it there because I didn't like the way it traded, versus here it was a little easier for the way I like to trade it. But I didn't trade it there, but that was tradable as well. Then all of a sudden the market decided, that it cared about companies at 20 times sales. And now Snowflake has a massive headwind, and, goes down, tries rally, goes down, tries rally, goes down. And, maybe that turns around, or maybe they finally start making money. But you really have to think about that when you're considering some of these stocks. So I paused, I got off tangent a little bit, but it made me think of that. So, when you're evaluating what you're buying, what are the characteristics of this stock? Is it, if you've read Bill's book, if you've studied previous winners, does it have the characteristics of big winners? Not every stock that I buy will be, a perfect model book stock, because that's not going to be that easy, unfortunately. But most of them, I want earnings and sales and return on equity and a kind of a tailwind if I can understand it, etc. Okay, so here's our contact information: marketsmithandinvestors.com, 800-831-2525. Last but not least, on June 18th, it's tentative, it's a Saturday. We do these virtual summits, and I know Jonathan and Arusha are going to do one on June 12th, I believe. And I'm thinking I want to do one that's MarketSmith centric. And it will really be about MarketSmith, using MarketSmith best practices. So like right now, what am I going to do this weekend to find ideas? What screens am I going to use? What reports am I going to look like? How am I going to set my alerts? What am I going to look for as far as stock selection? All of that, and it'll be high level. In other words, we're not going to explain how the pattern rec works, or or, I'm not going to talk about, what stage it's in or why we cut losses. It's going to be that you guys should already know all of that. Really want to help people because I get a lot of feedback and questions on, a lot of times like, Scott, how did you find that stock? That's the most common question I get. How did you find that stock? Well, it's through a screen, and I'll show you my favorite screens. Not that I have all the answers, but they're out there. The next great winners are out there. You just have to be putting in the work. So I wanted to throw that out there. Just curious what the demand might be like for something like that. Saturday for a couple of hours, free event, Marcus Smith, subscribers. I mean, I don't even think we'll allow anybody to watch, but it's really going to be focused on helping you to get more out of Marcus Smith if you need that. So tentative June 18th, which is a Saturday, and just curious, if there's any demand for that. If there is, I might do them more often. If there's not, no harm, no foul. I lose a couple of hours on a Saturday. It's a good risk reward trade for me. Okay, thank you guys. Have a great long weekend. Monday's a holiday. Thursday of next week is the webinar for the Stay in Step for our monthly webinar, Harold and I. So there will not be a take on the market on Friday. Have a great weekend, everybody. Bye-bye.